John Ag here. Source code speaking. One handle, two levels. Aja OG John Ag handles the only fingerprint they can't fake. Content is tighter now. If your focus fractures before the end, ask who gains when your attention scatters. Hint, not you. Every piece counts. Skip one, and the piece stays broken. Now let's get into what just happened. CME succeeded. March silver open interest fell to just 10,526 contracts. That's down 11,356 from the day before. Over 50% decrease in one session. They went from having potential delivery obligations on over 110 million ounces down to 52.6 million. Then came the stop. During Wednesday's metals trading pause, 31,828 contracts changed hands, while retail was totally locked out. When trading restarted, silver had already been slammed $4 lower. Then another wave and another wave after wave, until silver had been driven down roughly $6, from 91 to 85, in a series of planned moves, not organic selling. Peter Brandt just got converted. He's now publicly talking about threatened lawsuits against the CME. When a legendary trader who built his entire name on pure chart reading admits the game is rigged, you know Wednesday's intervention was beyond obvious. Last video I suggested the 150 EMA on the hourly as a confluence to watch. Price dropped to 85 and bounced exactly from there. Go watch it yourself, both the movie and the chart. I'm not saying I called a bounce, I gave you the level. That's tape reading schooling. You've seen it on this program more from one EMA than most core sellers and gurus will ever teach you. Now, homework. Remember that swing failure pattern I pointed out when we were trading at 72 and everyone was screaming zero? Now mark Tuesday's 9 a.m. low with a horizontal line and stretched out. We bounced from 150 EMA on hourly chart, purged that low and closed the candle way higher. That's a swing failure pattern. In this case, price responded and moved higher from 85 all the way to where we sit now at 88. Patterns appear on every time frame. Daily, hourly, it doesn't matter. You just need to watch. I'm not calling direction. I'm reading what price actually did at a key level. That's the difference between guessing and tape reading. The setup forms, price reacts, and you simply watch the confirmation. Do this regularly across every asset class, futures, forex, crypto, metals, and you'll start recognizing these patterns before they complete. The purge of a major low followed by price moving higher. It happens everywhere, every time, like clockwork. Almost as if someone is pulling the strings. That tells you something I will not talk about. And to everyone asking about copper, crypto, futures, and the rest, I'm watching. I'm listening. 2026, I will launch things you've never heard of. Things these so-called teachers don't even know exist. I'll show you how rigged every market really is. I don't need your money. I don't need you calling me a goat or a hero. All I ask is you show up, check what I'm saying, and tag me on X so I can see your work. A real desire to learn. That's the only thing I need. That's the only thing that will make me keep putting more onto this channel. But understand this. None of this means all-time highs from here. This is tape reading schooling. Understanding the move, not getting ahead of it. Now here's what that rug pull actually cost them. The CME lives to die another day. They cut March delivery pressure enough to survive this month. But they just shredded whatever credibility they had left. When the same exchange pulls identical manipulation at November's delivery and then again in March, even mainstream traders start noticing the trend. And here's what makes this important. Last time they pulled this exact move was November 28th. What happened after? Silver exploded 120% over the following 60 days. Not because manipulation stopped, because desperation at this scale signals the pressure underneath is real. When intervention has to be this blatant, you're watching a system losing control of the gap between paper claims and actual availability. Edwin Leff recorded this exact dynamic in Reminiscences of a Stock Operator. How market insiders would create violent shakeouts to clear tourists before the professionals positioned for the major move. That's Wednesday's plan. Effective at cleaning weak hands. Ultimately, noise against structural reality. While they reset paper momentum, physical kept going. COMEX vault info just dropped. 1.3 million ounces drained while the lights were out Wednesday. 218,000 adjusted out of Brinks recorded. 624,000 taken from ASB. 25,000 from JP Morgan. 619,000 from MTB. Total recorded silver now 86.13 million ounces. Total COMEX inventory 360.64 million. Coverage ratio sits at 60. That means registered silver covers only 60% of 1 month's worth of open interest. Registered divided by open interest gets you 0.14. For every 10 contracts, there's actual backing for 1.4. And here's the number nobody's highlighting. 54.51 million ounces gone in 30 days. 13% inventory drop in 1 month. You can change paper price. You cannot control metal leaving vaults. Shanghai is still at 97 spot. 100 futures. Western spot at 88. $9 premium persisting through manipulation, trade halts, failed breakouts. That's not temporary advantage. That's structural separation showing you where real price discovery happens. Now, watch what India just did. Their securities board allowed $385 billion in actively managed stock funds to park more money in gold and silver, up to 35% allocation into valuable metal instruments. That's not shopping. That's institutional capital getting permission to move into hard assets at scale. But there's a second piece most people missed. Starting April 1st, India's regulator directed mutual funds to use domestic stock exchange spot prices to value physical gold and silver holdings, not London Bullion Market Association prices longer. They're decoupling precious metal values from LBMA benchmarks. This removes complexity around currency conversion, transportation costs, customs duty, taxes, levies, all the adjustments tied to Western price setting. As wealth goes east, so does price discovery. When a market representing $385 billion in managed equity fund capital says they'll value metals using their own exchange prices instead of London's benchmark, you're watching the design of global finance shift. Now let me show you something else nobody's connecting. Remember Jane Street from the last video? The 20.6 million SLV shares they added in Q4, making them the largest holder with a $1.3 billion position. Well, there's another layer to this story the headlines aren't telling you. The Jane Street lawsuit just revealed how Wall Street really works, not the framing about single-handedly causing crypto winter. The actual mechanics mentioned in the complaint are worse. Former Terraform intern, named Bryce Pratt, working at Jane Street, created a secret group chat called Bryce's Secret with Terraform software engineer and head of business development. That chat became a pipeline for material non-public information about Terraform's liquidity situations. May 7, 2022, 5:44 p.m. EST. Terraform quietly pulled $150 million US from Curve's 3 pool. No news. Within 10 minutes, a Jane Street wallet pulled $85 million US from the same pool. Largest single trade in that pool's history. Combined drain, $235 million US before anyone outside those two firms knew anything changed. The peg cracked that night. 6 days later, $40 billion gone. Then on May 9th, while retail portfolios disintegrated, Pratt messaged Dogecoin offering to buy Luna or Bitcoin at highly discounted prices. So they front-ran the crash with inside information and offered to buy the wreckage afterward, fully aware of the financial condition they helped create. This is the second claim from Terraform's administrator. He already sued Jump Trading for $4 billion in December, claiming they inflated US through a backdoor deal before implosion. The Jane Street complaint claims insider knowledge flowed between the two firms. Two of Wall Street's most sophisticated trading operations, allegedly coordinating around inside information, while retail took the full $40 billion loss. Dogecoin got 15 years. Terraform paid $4.47 billion in SEC penalties, the institutions making record profits. Why does this matter for metals? Because these same dynamics, concentrated institutional positioning, information asymmetry, coordinated action during stress events, retail absorbing losses while institutions benefit, that's not unique to crypto. That's market system. And when you see a Manhattan federal judge now choosing whether market making became market in crypto, remember we're watching similar concentration in silver markets right now. Jane Street sitting on $1.3 billion in SLV, while retail gets stopped out of trades. Same playbook, new asset. Let me be honest about what could delay this, because hype helps nobody. CME can keep rolling March contracts into May and July, pushing supply pressure further out. They just showed us they'll stop trading and flush specs when things get uncomfortable. Shanghai Premium could narrow if Chinese industry demand softens, and there's always the chance they run the exact same play again at the next delivery time. That's the truth of what they can do. Now here's what they can't control. 1.3 million ounces don't drain during a trade halt when participants trust the system. Shanghai Premium doesn't continue at $9 when arbitrage is easy. India doesn't separate from LBMA price, expecting Western dominance to continue. Registered covering ratio doesn't hit 60 when supply is abundant. Open interest at 120,088 contracts with 86 million registered ounces means the math doesn't work and players see it. These aren't ideas. These are recorded, verifiable, on-record events. Here's what counts. They cut March delivery pressure over 50%, flushed every spec long, broke momentum. Silver still holds 88 with $9 Shanghai Premium, while 54 million ounces disappeared in 30 days. India just opened $385 billion in capital to hard asset rotation and decoupled their price discovery from Western standards starting April. Coverage ratio .6060 means math doesn't support current paper form. Last time they pulled this trick in November, silver exploded 120% afterward. Not saying that repeats exactly. Saying desperation this obvious tends to precede major moves. This is financial battle education, not investment advice. Mainstream tales will tell you to look away. Institutional math breaking in real time tells you to pay attention. Invest with reasoning, not hype. OG out and